Stocks are falling for the fourth day in a row, but now pulling off the day's lows. Traders are citing a number of factors for today's drop. That includes declining energy stocks, disappointing sales at Alcoa, and 2 more earthquakes in Japan. Those are some of the things really weighing on the equity trade today. So the question at this point is, will the sell-off continue, or will earnings season, which has just started, and more merger activity renew the rally? Joining us to talk about this is Mark Luschini. He's chief investment strategist at Janney Montgomery Scott, where he helps to oversee $35 billion in assets. Mark, good to have you here on Street Smart. Feels like a wall of worries today in the market. Does it continue? Does it hold back some of the equity gains that we see in the next few months?
Well, there's clearly a wall of worries, but I think on balance, equities should be able to get some traction and continue their advance. We're too early in the earnings season to write off what company profits are going to be. Alcoa is interesting, but I think hardly necessarily a bellwether of what we're going to see across a lot of industry sectors, including staples and healthcare and technology. So I do believe that equities are in a better position than they were several years ago, from which we can continue to see an advance predicated upon the buttressment that they're getting through economic growth that is expansionary rather than just recovery.
Hey, Mark, hard to find somebody who would argue that we're in better shape than we were a few years ago, especially when we're in the midst of the financial crisis and so on. But we've had a great rally from those March 2009 lows. At this point, I mean, how much more in terms of gains can you expect, even if corporate earnings continue to be fairly healthy?
Well, I don't expect that we're going to see the kind of gains we saw coming out of 2009 and 10 repeated in 2011, simply because we are in a pace of earnings growth that is slowing vis-a-vis comparisons over quarter sequential numbers, let alone year over year. But nonetheless, corporate profits are expected to grow in low double digits in 2011. Interestingly, while equities have advanced about 100% off the lows in March of 2009, the valuation has gone from about 10 times earnings in 2009 to today's 13 times 2011 estimates. So valuations are still undemanding, which should allow, on the basis of corporate profits continuing to show decent growth, equity prices to continue to move higher.
Mark, what about, though, folks who are tempering back their growth estimates, global growth estimates, estimates for the United States? We've seen some numbers come out of the IMF just over the last day or so, also today. Doesn't that make you kind of hesitate a little bit in terms of more equity gains?
Well, certainly it's worrisome because of the contribution to the revisement of those economic growth numbers is primarily in the form of, budding prospects of inflation in the pipelines around the world feeding into the United States, elevated energy prices, which could move higher on the back of a further supply shock, and as well a consumer that, while deleveraging, still isn't in the healthiest of positions that we would like for them to be. But that all said, that doesn't necessarily mean that equity prices can't be supported by a combination of the positive factors regarding global economic growth, which is still expected to be better than 4% in 2011. And in addition to that, the lack of competition from other asset classes, namely bonds and cash, that offer little in the way of yield to distract investors away from the prospects for equities, particularly those that pay a handsome dividend.
You sound very, very upbeat. And I'll be honest with you, the thing that caught our attention initially was something you told Bloomberg yesterday, and you talked about that corporate America was in great shape, plenty of cash on hand for acquisitions. We have seen the acquisition market, the M&A market, definitely pick up. You expect that to continue? And if you do, how supportive is that for the overall equity market?
Well, most definitely. It's well known at this point that corporate America is sitting on roughly $2 trillion in cash. Balance sheets are in good shape. And with valuations being undemanding, that is feedstock for corporate America, who is increasingly confident in surveys of CEO sentiment about forward-looking activity, about what the prospects for their business look like over the course of the coming quarters. And that, I think, is helping to manifest in companies announcing acquisitions outright of businesses and or bolt-on acquisitions, such as like a Diamond Foods buying Pringles from Procter & Gamble.
All right, so expect maybe more M&A activity. But what about when those companies feel, I'm hearing, companies feel great, they've got lots of cash, but when are they going to feel confident enough to go out there and aggressively do some hiring? I mean, it's gotten better, but we're still a long way from where we were just a few years ago.
It has gotten better, but here's an interesting statistic. It's estimated that corporate profits by the third quarter of this year on a trailing 12-month basis will exceed that of the peak in corporate profits back in late 2007. but it's done so with 8 million fewer workers today than were on the payrolls back in 2007.
So what, we're just so much more productive? Is that what it's all about?
In a word, is productivity. But I think we're reaching a point where, in order to continue to service increasing revenues on the top line, hiring plans are going to have to be expanded. And as a consequence, we expect payroll creation to continue, albeit at a less than stellar pace, but positive nonetheless.
And doesn't it worry you also, though, that, we look at wage, we're not really seeing any kind of wage inflation. I mean, companies, even though they're flush with cash, they're not really paying workers. I don't need to remind you about how important the consumer is to the overall economy.
It's a problem, no doubt about it. Wage growth has basically flatlined over the last 12 months, but the fact of the matter is employees have little in the way of leverage given the enormous output gap that still exists in the economy to go to their employers and demand a raise.
Are you giving me some advice?
There might be some embedded in it.
Mark, we got to run. Thank you so much. We appreciate your time this afternoon.
Carol.
Mark Luschini of Janney Montgomery Scott.